Welcome back. Let's get into some market news now. Asian markets mostly rose on Wednesday following a strong lead from Wall Street. But traders remained on edge about the global economy while oil prices extended gains. That's particularly after Russia reassured of its intention to cut output. Now, trading remained choppy across the region after the key U.S. gauge raised a red flag warning of recession, adding to Federal Reserve worries about growth. Now, uncertainty over Brexit and China's stuttering economy added fuel to the flame. While the optimism that has characterized most of 2019 thus far has been shaken in recent weeks, a weak round of U.S. data was unable to prevent a rebound in New York Tuesday, with all three of those main indices also ending the day higher. Gains for some, but Tokyo went the other way as the Nikkei edged 0.2% lower at 21,378 points. The Hang Seng moved 0.6% higher, closing out at 28,728, and it's 3,022 for the Shanghai Composite, 1% better off. U.S. stocks gained on Tuesday, with financials snapping a 5-day losing streak as Treasury yields stabilized, mainly above that 15-month low. The Dow Jones Industrial was more than 0.5% to the good, rising to 25,657 points. The S&P 500 gained 0.72% to end at 2,818 points, and the Nasdaq Composite moved up by a similar mark, 7,691 points at close. The market has sincerely been worried, of course, about that growth number. It's hard to believe that things could change in the matter of a day with regards to that gold figure and, of course, to the growth figure itself across the globe. But it seems that the local market is faring a little bit better, 0.4% to the good thus far when one takes a look at those numbers. But Europe itself clearly not faring as well. Here are those numbers. We'll analyze them right after this. Complete weakened state of South Africa's currency. They're now even going further to around 14.63 as of late as well. That figure not doing so well. So let's chat to Viv Govender now from Rand Swiss as we unpack that market picture a little bit more. Viv, thank you so much for the time. But a sense of positivity for the JSE All Share, but it's really those Rand hedge stocks really doing a little bit better, isn't it?
Yeah, the currency has weakened significantly, breaking through what I thought were recent support levels, just about 1450 or so. I mean, breaking through 1460 for a bit. And that, I think, is quite troubling going forward, especially considering just how high the oil price is at the moment, around about the $67, $68 a barrel level. That combination is going to be very bad at the petrol pump come next month.
Yeah, that's bound to hurt, as you say, and we continue to have some sense of optimism that even though the JSE All Share heads a little bit higher today, it's been pretty much flat for most of this year thus far. Is there any way in particular that you would look for perhaps some gains?
Well, of course, there's that Naspers, deal. People are talking about the possibility of adding 20% to the value of Naspers if things go through as had been hoped. And Naspers being about basically 20% of the total market would be to make a big impact on that. But I mean, we've been helped to a certain extent for this year by the resources prices, which have obviously been helped by the weak currency, but also to a certain extent by some kind of recovery with regards to the sector as a whole. That being said, we also see reasonable profitability coming through from the banking sector. Retailers have been under pressure, as we all know. What we need to see for this country is a couple of things. Firstly, confidence return. Hopefully that comes after the election. We need, of course, to avoid that downgrade on Friday and have it being avoided permanently thereafter. And I think we also need to see economic growth tick up. I mean, we are seeing numbers for economic growth for the first half for 2019. Looking at about 1.3, 1.4%, and that was before load shedding, which may have cut as much as 0.3 out of the total growth number. So we could be seeing growth rates for this year struggling to beat 1%, and that's obviously another negative for the stock market as well. Yeah,
it will be quite difficult to ascertain, of course. Very quickly then, your thoughts, do we then avoid that downgrade on Friday? And also then, if you'd go a day earlier, that's tomorrow, Thursday, you have, of course, that interest rates decision. Do you see us at least holding rates there as well?
Expectations of our rates holding tomorrow, and for no change in terms of the rate on Friday, but an outlook change, possibly to negative come Friday. And so I think that's the expectation at the moment. Look, I mean, when it comes to our inflation number is going to be hit quite badly, like I said, because if the rand remains where it is and the oil price is where it is, we're going to see quite a bit of, cost push inflation coming through into the system over the next few months. With regards to Moody's, they've been very, very generous with us, and I think there's possibly they're going to continue to be that generous going forward. But I do think it's justifiable to say that we should have a downgrade, at least the outlook, come through on Friday.
Yeah, still some bad news for the local economy indeed there. Okay, so have fears dissipated somewhat of global growth? Because clearly our market seems to have gone up, but if you take a look at Europe, that's gone down, and perhaps some would say that's primarily because of Mario Draghi and his speech, which was a little bit earlier on today.
Yeah, look, I mean, one of the triggers for that whole recession talk on Friday and Monday to a certain extent was that whole yield inversion. And it's a yield inversion basically is when the long-term yield on towards Treasury is lower than the short-term yield, which should not be the case. And the last few times it's happened, it's almost invariably led to a recession soon after, or was preceded a recession. I don't know if there's a cause and effect kind of thing going through there, but there's definitely a correlation that we can talk about. We have this yield inversion, and then we have, a recession that follows. I think to a certain extent that's dissipated. I mean, the quantum, the size of this inversion was not quite as large as the last couple of ones that preceded recessions. Talking about Europe, I mean, the European Union is obviously in a bit of pressure at the moment. Growth rates are under pressure, and they, of course, have the whole Brexit situation to deal with as well, which, quite frankly, I don't understand what's going to happen. I mean, seriously, we're 2 days away from things on the 29th of March, and they are debating what exactly they want from a deal 2 days before the deal has to be there and in place. It's amazing just how close they put it to the deadline. I personally believe it, because it's gotten so bad at the moment, that if there's any sensibility left in the British political system, they'd probably go for a second referendum or for some kind of cancelling of Brexit, because right now there's almost no chance that they could do a Brexit without causing massive damage to the UK economy.
Yeah, one would say then it's definitely going to be difficult across the board, no matter what happens with regards to Brexit. Mario Draghi continues to say that he has, perhaps enough levers up his sleeve. Do you share a sentiment like that? That even if the economy does continue to go downward, that they'll be fine?
No, I mean, I think to a certain extent Mario Draghi is the same position as our central bank governor. There's things they can do, and he's done as well as he could do in the circumstances he's facing. But he's facing a number of situations that are outside his control. I mean, he can't go out and try and really boost economic growth. We are seeing also a lot of disturbances happening in places like Italy and France, with that whole yellow jacket thing in France, and of course the election of that populist parties in Italy. And those kind of factors are just out of his control. There's nothing a monetary policy, instrument can do or lever can do in that kind of circumstance. What he really wants to see is better economic growth. He's done as much as he can. I think on his side, we are probably going beyond, what people thought he could do in that circumstance to actually boost the growth, certainly more than his predecessor, Trichet, did. But that being said, I mean, he can't really change the structure of the European economies. He can't do much about this whole Brexit thing, which will have the biggest impact on Europe outside of the UK, of course. I mean, the biggest impact is going to happen in the European Union. And he can't do much about that himself. So he's done as well as he could. The things he's saying at the moment is the similar kind of stuff he said in the past, like, I will do whatever is necessary to promote growth and that kind of thing. Yeah. And I truly believe that he will do whatever is within his grasp to do that. I'm just not sure that he has the ability to actually change the course of that, that regional economy. Yeah,
a difficult time for him indeed, and we'll continue with that story. Viv, appreciate your time there, but Viv Govender there from Rand Swiss. As we said, we'll continue with that story with regards to Mario Draghi and the European Central Bank, as the president had his own meeting this morning. As I said, Mario Draghi, they're saying, of course, that he has indeed decided on what might indeed be able to happen. He has denounced any prospects of an interest rate hike in the European Union to next year. He says this is due to a more persistent deterioration in external demand, which may affect investment in the EU's manufacturing sector, especially as global uncertainty rises. Now, Draghi was delivering this last speech, which is his last, as I said, as president of the ECB, reiterating his cautious approach on the growth prospects of the European Union. Let's take a listen.
Our current reaction function is well designed to respond to further delays in inflation convergence. In such a situation, just as we did at our March meeting, we would ensure that monetary policy continues to accompany the economy by adjusting our rate forward guidance to reflect the new inflation outlook.
Despite him saying, of course, that they're willing to delay the rate hikes for, an infinite number of years and perhaps even into 2020, depending on what the scenario of the global economy looks like, one could certainly say that he has said that the levers that he could pull to perhaps stimulate the global economy and his own economy, indeed, the European economy itself, is one that could certainly move forward in accordance with any of his plans. He does have the levers in hand to do so, and he's willing to break those and use those at any point in time. He has said that he will take fresh action if needed to stimulate the Eurozone economy. It is difficult in a time when Germany has just announced that they have sold their 10-year bond at a slightly lower level, at a negative yield, shall I say, for the first time since 2016. This means that if they do hold out on those bonds until 2029, then Germany would have made a loss on those bonds. That clearly tells you then that the demand for things like German bonds, which is of course one of the strongest economies in the Eurozone, is really faltering. Things are indeed quite difficult for an economy like Germany. So the invert to that we spoke about as well when you cross out to the United States, where we talk about the yields inversion, where the short-term yields seem to bring out more money than rather less money than the long-term yields. Thus then brings you to a state of fear about recession in the United States. But that fear could break out across the globe. Take a listen to this. If you have the United States going into recession and you ultimately factor in that the EU could do the same, considering that Brexit in itself hasn't even been sorted, and growth in Germany, which is the largest economy in the Eurozone, is scheduled to hit around 0.8%, the effect on that with trade relations with the rest of Africa, specifically South Africa, could certainly see South Africa unable to produce the numbers it used to in the past when it comes to that trade number. So the trade deficit goes wider and wider, which of course breaks the bank locally, and we're unable to get things on board, and we raise prices because of costs. Inflation goes higher, and of course the South African Reserve Bank, whose main mandate is of course that inflation rate, then they ultimately hike interest rates. Things go from bad to worse, and the growth that we continue to seek of at least 1% or more gets stifled, and you certainly don't get a better picture at all. Yes, we were able to create 87,000 new jobs in the formal sector yesterday, but one can attest to the fact that that certainly isn't the be-all and end-all. It won't make a huge dent when it comes to the unemployment figure of 27.5%. So the aim here is not to look externally for any growth factors for South Africa, but certainly what we could do in order to boost the nation. Now, Mario Draghi's last message there, indeed, as we posted out, is one that will certainly be of keen interest to quite a few people as well, and just how many can hold out. What are the levers he will use when it comes to this facet as well? The trade disputes hurting Eurozone companies, and they have to now find a way to break through the mire. It may seem like 2008 and 2009 all over again, but this time perhaps for a protracted period and not just faced with one issue alone. It will be quite interesting to take a look at how markets fare from here on in, and we will of course have all that information for you right here on Market Sense. After the break, we take a look at an in-depth look at how the United Kingdom got itself into that Brexit mess. Do stay tuned.